All right, let's talk about a company that literally tore its DNA apart and rebuilt itself right in the dead center of the AI revolution. We're looking at Marvell Technology. We're going to dive into how they morphed from a traditional networking company into an absolute powerhouse for custom AI silicon and optical interconnects. It's honestly a textbook case of strategic maneuvering, and it has massive implications for the future of data centers. Let's get into it.
To really wrap your head around the sheer scale of this pivot, you just need to look at this one number: $6 billion. That's how much revenue Marvell pulled in from their data center segment alone over the last fiscal year. That is a jaw-dropping 46% jump year over year. This isn't just incremental growth, guys. This is their strategic bet on data center AI infrastructure paying off flawlessly and hitting record-breaking numbers.
Here's the roadmap for our analysis today. We'll start with their explosive stock rise, then dig into their core AI growth drivers and strategic capital reallocation. After that, we'll do a reality check on their current valuation, break down the key risk factors you need to know about, and wrap up with the Wall Street outlook.
Section 1. Explosive stock rise.
So, Marvell's stock has absolutely skyrocketed, clocking a massive 221% gain year to date. I mean, they completely blew past Wall Street's early targets, leaving analysts scrambling to upgrade their price predictions just to keep up. But you have to ask yourself, is this all just hype, or is there solid ground under this massive run-up?
Well, the answer is right there in their actual financial performance. Like they mentioned in their earnings call, Marvell delivered a total revenue of roughly $8.2 billion, marking a 42% year-over-year growth. And management made it crystal clear, this explosive growth is being primarily driven by the insane demand for AI and data centers. So this price action? It's heavily backed by real, tangible revenue.
Section 2. AI Core Growth Drivers.
Think of Marvell as the company laying down the nervous system for modern AI data centers. The real engines behind their revenue model include highly optimized custom AI silicon built specifically for major cloud providers. Then you've got their PAM4 and coherent DSPs. These are optical modules that beam massive amounts of AI data at the speed of light, doing a job that traditional copper wires just can't handle anymore. Throw in high-speed data center switches, and Marvell is literally building the crucial plumbing for the AI revolution.
What's really mind-blowing here is their custom silicon business. In just a few short years, this segment exploded from absolute zero to $1.5 billion in revenue. And get this, management is projecting this massive number to double again. By locking in multi-generational AI processor deals with some of the biggest tech giants in the world, they've secured a massive, highly stable stream of recurring revenue.
Section 3. Strategic Reallocation. This is where you see management being almost ruthless in their focus. They took their highly profitable legacy automotive Ethernet business and completely divested it for $2.5 billion in cash. Why? Because the automotive design cycle is just way too slow and AI is moving at lightning speed. Then, they immediately turned around and dropped $3.25 billion to acquire Celestial AI. They traded slow, steady certainty for an aggressive, essential bet on hypergrowth. So, why Celestial AI? Because this acquisition hands Marvell the keys to the kingdom for something called co-packaged optics, or CPO. In plain English, this tech integrates optical chips directly into the processors, totally shattering the physical bottlenecks of traditional copper wiring. We're talking about expanding bandwidth by up to 25 times while massively cutting down on latency and power consumption. Marvell isn't just cashing in on today's AI boom, they've secured the growth engine that's going to drive data transfer for the next decade.
Section 4. Current Valuation.
Now let's do a reality check and look at the valuation metrics. The absolute standout here is that forward PE ratio sitting at roughly 37. Since forward PE is based on expected future earnings, a multiple this high means the market has already priced in massive, sustained future growth. Investors are willingly paying an enormous premium today for the perfect earnings Marvell is expected to generate tomorrow.
Because the stock is priced for sheer perfection, trading near historical highs. There is literally zero room for error. If they miss an earnings target, if a product gets delayed, or even if growth just slows down to a quote-unquote normal rate, they're at a very high risk of multiple compression. Essentially, even if the company is still growing, if it isn't fast enough to justify that 37x premium, the stock price could take a serious hit.
Section 5. Key Risk Factors.
So we have to talk about the threats that could derail all this momentum. First, US-China trade restrictions and supply chain vulnerabilities are always lurking in the background. Second is their heavy reliance on cloud CapEx spending. If major tech companies suddenly slash their AI budgets, Marvell's revenue takes an immediate hit. But the most lethal threat by far is vertical integration. Hyperscalers like Amazon, Google, and Microsoft are aggressively developing their own in-house chips. If they can build what they need without Marvell's custom designs, a huge chunk of Marvell's revenue stream could dry up overnight.
And on top of that, competition is heating up fast. Just look at the recent news of Qualcomm securing a major AI chip deal with ByteDance. While this proves just how massive the market for custom AI silicon is, it's also a glaring warning sign that heavyweights like Qualcomm are aggressively invading Marvell's turf. Over time, this intensifying competition could really pressure Marvell's long-term pricing power and margins.
Section 6. Wall Street Outlook.
Yet despite that steep valuation and the very real threat of hyperscalers building their own chips, Wall Street analysts are overwhelmingly bullish. More than 84% rate the stock as a strong buy, and literally no one is saying to sell. Institutional investors clearly believe that this AI infrastructure supercycle is so powerful it easily outweighs those valuation and risk concerns, at least for the next 12 months.
You can see this optimism baked into the consensus average price target of $392.14. Even after a 200% run-up, analysts still see roughly 30% upside potential. Recent upgrades from major institutions like Benchmark and KGI Securities show a deep confidence that Marvell's dominant, entrenched position in optical networking and custom silicon will act as an ultimate safety net.
So, it all comes down to this provocative question. Is this 37x forward multiple the absolute peak of an AI hype cycle ready to pop with one misstep? Or is it merely the foundation of a massive, decade-long infrastructure boom, where Marvell's tech becomes as essential as electricity? The data makes a compelling case for both sides, so you'll have to weigh the odds yourself. Whatever you decide, you're definitely going to want to keep a very close eye on Marvell's next earnings report.